In my career as a financial services professional, I found that there are 4 phases of creating wealth and managing wealth. Most financial advisors and professionals only talk about 3. I'm going to share with you the 4th one that most financial people forget about, and I don't want you to forget about it. So I'm going to share with you the first 3 and the last one, but stay tuned to the end because that's when I'm going to share the 4th one that most people forget about, and you're not going to want to forget about it if you want to make sure that you have and create what's called generational wealth. Welcome to the channel. My name is Paris Clough, and this is Financial Self-Reliance. I absolutely love helping people manage, protect, and grow their money. And in this video, we're going to talk a little bit about each one of those areas. So there are actually 4 phases of wealth creation and management that are critical to your success if you want to create generational wealth. Generational wealth is like the Rockefellers or the Kennedys. These are people that created so much wealth that generations upon generations are taking advantage of that kind of wealth. Would you like to be the guy that 3 or 4 generations down the road, great grandkids are saying, well, I'm so glad that great grandpa or great grandma, whoever established this habit for our family and changed our whole family tree and the way we create and build wealth. That's what you want to do. If you want to create enough wealth that not only you're going to live comfortably, but enough that you'll be able to have for all your children and grandchildren and down the road and onto the generations to live comfortably, you're going to want to watch this video all the way to the end. The first phase in building and managing and creating wealth is the contribution phase. Now, the contribution phase is important because this is really the seeds that you're going to be planting as you're growing and building this wealth that you're going to accumulate. If you don't have enough seeds to really build, you're not going to have the harvest you want. So it's really critical that you get good at managing your money, knowing how much money is coming in, knowing how much money is going out, and then finding out how much money you have to invest. So you're going to want to be able to make more money than you're spending. That's the key element here. Having a positive cash flow is critical to the contribution phase. When you have a positive cash flow, you're going to have money to contribute to your investments. So when you have given yourself an opportunity to look at your expenses, look at your income, and manage that properly, now you can see how much money you have left over in your income to then put into savings. And then once you put money into savings and you've got a little buffer zone, then you want to put that extra money into investing. And investing money is the first phase, is this contribution phase where you contribute money each month. The amount of money you contribute each month is going to determine the amount of money that you'll have at the end. So the seeds that you use will determine the harvest that you have. The amount of seeds will also determine the amount of harvest. So make sure you're investing or contributing money to the right places. If you want to really grow your money well, you're going to have to contribute to places that are going to give you a better rate of return. A better rate of return leads us to the second phase, which is the accumulation phase. Accumulating money and building money and allowing the power of what's called compound interest work in your favor gives you the ability to really have those seeds grow into that significant harvest of wealth that you want to have. If you're accumulating money in the wrong place, or if you're contributing money to the wrong place and it's not accumulating fast enough because your rate of return is wrong, you've done it wrong. You've got to put your money or contribute money to those places like the stock market, like real estate, like building a business. These are the places where you're going to accumulate wealth. In terms of investments and the market, the best places to accumulate wealth is in what are called indexed funds. 7 to 8 out of 10 money managers can't even beat the index. So if you really want to kind of have that set it and forget it, and you want to make sure that your risk-reward ratio has really got the best opportunity, and you want to have what are called the odds in your favor, then having a good, strong index fund is the way to go. Warren Buffett is actually known and far and wide for saying that if you want to invest in the market, pick a good index fund and just pour as much money into it as you can. So that second phase of accumulating wealth is critical because if you're earning 1% or 2%, you're never going to make it. If you're earning 8, 9, or 10%, you have a chance. So accumulating money in the right place is critical. Also, part of accumulation is where you're putting that money, because if you're contributing to a tax-advantaged location, you're going to accumulate wealth differently than if you're putting money or contributing money to a taxable location. So accumulating wealth is not just rate of return, it's also about the tax implications of where you're accumulating that wealth. The third phase of wealth building and wealth creation and management is the distribution phase of wealth. If all you've ever done is put money or contribute money to a tax advantage location like a 401k or an IRA or other qualified plan, and then all that money accumulated, now in distribution, or as you begin to take that money out and use that money or need that money because you've retired or you've gotten to a place in your life where you'd like to stop working and draw down on your investments and your accumulated wealth, then you're going to have that wealth pay you. And where you put that money will determine the kind of distribution you take. Some people who put all their money into these tax tax qualified locations are going to have to worry about taxes, because one of the things that most people don't realize is that if you have money in a tax advantaged location like a 401k or IRA, you get a tax break as you contribute. You get tax deferral as you accumulate, but in the distribution phase, you pay the full tax. So you're gonna have to remember that as you're accumulating wealth. Make sure you're accumulating some wealth in taxable locations and some wealth in tax advantage locations, so that as you distribute that money, you're distributing some money from tax-free locations, from taxable locations, and then others from tax advantage locations. One of the things that I want you to realize that there's qualified plans, and then there's Roth IRAs, which are also kind of qualified plans, and then there's other plans that you can put money into that are not qualified, that when you pull that money out or take a distribution, that it can come to you tax-free. That's the kind of place you want to put your money into. So Roth IRAs, and also what are called life insurance retirement plans. Now there's a lot of controversy about life insurance retirement plans. If you do it properly, it's absolutely fantastic, and it's a great way to accumulate some wealth and have that as a part of your portfolio. The other place is that if you have a taxable location that you're investing into and contributing to and accumulating wealth in, every year you're paying the taxes on the gains or the losses. Well, you're not going to necessarily have a large tax bill as you distribute that money, because you're going to qualify for what are called long-term capital gains. It's much less than what an income tax would be, but it's much higher than what a tax-free is going to be. So there's different reasons and ways to distribute money. Make sure that when you accumulate wealth, that you're distributing it as well in the right places and from the right places. So beginning with the end in mind is critical. If you have an idea of how you want to distribute wealth in your later years, that will let you know what kind of things you want to start contributing to now in your younger years. Fourth and final phase is the one I was telling you about that most people forget about. So far, we've learned about contributing, we've learned about accumulating, and we've learned about distribution. Distribution is where you take the money out. Now, before I get into this fourth and final phase that most people forget about, I want to just remind you that some of the best places that I put my money for accumulation are listed in the description below. I've got links to some of the places where I put my money for savings accounts, high yield savings accounts, where I put my money for my investments, where I do my index investing, where I do my ETF investing, and then where I do my dividend stock investing. There's links in the description below. Some of the places like M1 Finance, if you were to use the link and open an account, you get to have $50 free. If you use Webull, which is the main brokerage that I use for my dividend investing and my options trading, that link will give you several free stocks if you open an account there. And then I'll also have a link for some of the tools that I use. So make sure that you're taking advantage of some of those tools like I am, that will help you make sure that you're contributing, accumulating, and distributing the wealth in the most efficient and effective ways. So fourth and final phase of wealth creation management is the transfer phase. Most people don't realize is that they might be able to create a large amount of wealth for themselves in their own life, but if you don't do proper estate planning, most of the time you're going to lose all your money as it transfers from one generation to the next. In fact, the statistics show that most millionaires, within 1 or 2 generations, all the money in that family is completely gone. And most of the reason why is because nobody teaches the children how to manage money. They don't teach them the things that they learned about contributing, accumulating, and distributing wealth properly. And so when they receive the money, they waste it all. Or more often than not, what happens is a lot of people will accumulate a lot of wealth, have a large estate, and they don't put it into a trust, or they don't do any estate planning, and the IRS comes in and grabs up to 50% in estate taxes. So make sure you're doing your estate planning. One of the things that we go through life doing is thinking about the future and really working hard to be able to have a nice and wonderful future. But one of the last things we think about is death, and it's not very exciting, and I'll be honest with you. But we're all going to have to worry about this and deal with it, and the more we plan for it and the more we're prepared for it, at least the more we prepare so that our family's ready for it, the more that our wealth that we work hard for can go to the people that we love and not go to Uncle Sam, who, I don't know about you, but I don't necessarily have an affinity to Uncle Sam. But I don't want to have my money go to the IRS or to some government bureaucracy. I want to have my money go to the charities that I love, the people that I love, my kids, my grandkids, my great-grandkids, hopefully if I live that long to see those. But I want to be able to create generational wealth. And the way to do that is with that fourth phase, that transfer phase, understanding how to properly transfer wealth from one generation to another with estate planning, trusts, wills, some other things that are involved there, getting together a mastermind group of advisors that will help you and train you and teach you so that when you accumulate a lot of wealth, you can then transfer it to the next generation. I hope you got a lot out of this video. If you missed the last one that I made, you can find it here. Go ahead and subscribe to the channel up here and check out this video that YouTube thinks you might like. Until the next video, I hope you have a great day.